Hey folks, before we get started, I just wanted to tell you, you can unlock unlimited access to political news, commentary, opinion, and a whole lot more at inforum.news/port for only 99 cents a month for your first 3 months. Hurry, get this limited time offer at inforum.news/port now. This podcast is brought to you by the North Dakota Petroleum Foundation. From heating our homes and powering our vehicles to cell phones, clothing, and medical equipment, oil and natural gas makes everyday life better. North Dakota Oil and Natural Gas, advancing the possibilities. Learn more at ndpetroleumfoundation.org. Welcome to Plain Talk, ladies and gentlemen, and the world's watching in horror at what's happening in Ukraine. And I mean, yesterday the Russians were attacking Europe's largest nuclear power plant. At one point, it was on fire. Now it seems like the situation is under control now. But if that thing had gone up, I saw one reporter was like, that's 10 times bigger than Chernobyl. If you watched that recent HBO series or read some of the recent books as I have about the history of that place, the potential for disaster was very, very close. So this is a horrible, horrible situation, war of aggression in Russia, and all of us here in the United States, I think, are asking what can we do? Obviously to help our Ukrainian friends, but also to stop enabling the Russian regime. And a lot of that's happening. We have seen divestment. We have seen our federal government acting in concert with a lot of the other world's governments, particularly Europe's governments, in saying we're not going to do business with Russia anymore. We're not going to allow trade with Russia anymore. Where that hits home here in North Dakota is our state government has, billions of dollars in funds that we manage. And some of those funds were invested in Russia. Now, yesterday, the State Investment Board met, and first of all, they got the news that we've already reduced our, investment in Russia or Russia-facing investments by 37%. But there's about 10 million left that still needs to be dealt with, and the board is coming up with a plan to get rid of that. Here to talk with me about all of this, and more importantly, I think the plan is, what do we do going forward? Here with me to talk about all this is North Dakota State Treasurer Thomas Beadle, who is one of the board members of the State Investment Board. Thomas, how you doing?
Doing well, Rob. Thanks for having me on.
All right, so first of all, tell us what the board did yesterday.
Absolutely. So, as the situation has been evolving with Russia, I mean, this is something that we've been paying attention to closely, really closely in the last few weeks. In a larger scale, we've been looking at this going on the entire time that I've been on the board. And I know there was conversation since before I joined the board as well about how do we deal with some of these bad actors? How do we make sure that we're putting our money in areas that are, good, sound investments for our citizens? Specifically with regards to Russia and the conversations we had yesterday, we know that there's the entire international market right now is exiting positions in Russia. They're exiting and eliminating their exposure to Russia. On the whole, we were underweight on our emerging market exposure, underweight in our Russian exposure as a whole. If you look at a lot of
underweight, what does that mean?
So we're directed by client boards to have an asset allocation of 20% in the legislative session just passed the in-state investing, 20% of in-state investment, 10% in fixed income, 10% in equities. Similarly, we have larger direction of we need to have 60% in stocks or equities, 40% in bonds. Of that, we want 10% in real estate. We want 30% in foreign markets or emerging international markets. So there's a whole bunch of different breakdowns. In terms of our asset allocation, we were about 0.5% low on our emerging market exposure, especially within our pension funds. So we were already underweight. And then within our portfolio, if you look at some of the most commonly traded index funds or bond funds, such as like the iShares MSCI ETF, which is one of the most common shared ones on Robinhood, which a lot of folks have it for their own individuals accounts. Those funds are closer to 16% exposure of Russia. We were under 0.5%, just because our fund managers have already been taking into consideration some of those risks. So we were underweight in our overall exposure, but we wanted to figure out how can we start getting rid of the rest of it. How can we get out of our positions that we have in bonds and stocks? And I think it's important for everyone to realize we don't. I've seen some reporting about us directly investing to fund Putin's Russia and some other stuff. We don't directly invest there. Everything that we've acquired, we've gotten on the secondary market. It's like when you buy a car.
That seems like a distinction without a difference, though, because I'm one of the ones who wrote that we were directly invested, and I'm looking at the position sheet that was provided for the legacy fund, and those were Russian bonds. Those were government bonds to the Russian Federation.
Right, but we acquired those. These are bonds that we've had in the fund for years, and these are funds that we're working on getting rid of. I fully agree with divesting it. The distinction is where we acquired those bonds. When we acquired them, we got them off of the secondary and third market, and so our money didn't go to Russia. Russia already had that money. Now we just acquired it at say an 80% discount, but we're still receiving the payments off of it. So where we get the revenue from it, our money didn't go to fund Russia. It's like if you buy a Ford truck, if you bought it at the Ford dealership, Ford gets the money. If you bought it from your neighbor John down the street because he was upgrading and bought it from someone else, Ford didn't get that money. John got that money for that secondary sale. So that's where the distinction is.
We're still holding. I mean, we were still holding Russia's debt.
We still had bonds that Russia was making payments on. Yes, I mean no doubt about it. I'm not disagreeing with that, and we are selling that as fast as we can. But some of it is now we're figuring out how can we do this in a strategic way, that a organized way, especially when we have the market right now causing us to a lot of the mechanisms for selling positions have been frozen. You're not able to make certain transactions and everything else, and everyone in the world is selling these right now. So we met yesterday and we advised our managers on how we wanted them to get rid of these positions, and now it's up to them to go and continue on with the divestment. As you mentioned, they've already offloaded about 37%, 37.1 is what they were yesterday morning. They have since been able to get rid of some more positions. Landlord, similarly, they've been able to eliminate a lot of the positions, and we're working on the rest of it. Some of it, we have a bond maturing next week. So we'll be out of and exiting that position with that maturation of the bond next week. Some of that will just happen, in stage phases over the next few weeks, few months, as we totally get that down to zero.
And just to be clear, I mean, we were talking about $15.9 million in investments in Russia. I'm reading here from the press release sent out by Governor Burgum's office. $15.9 million in investments with Russian exposure across the state's legacy fund, pension funds, insurance pool, all of which was overseen by the SIB.
Correct.
And that's and of that, the 5.9 million, or the 37%, we've exited those positions. That's done. And so it's this remaining 10 million, and 7.8 million is commingled. Is part of the reticence like a cost? I mean, there is a point. I completely understand the idea. Some of this is maybe sunk cost is the wrong word, but it's a done deal, right? Like the investments were already made. So do we cut off our nose to spite our face, pulling those back? I don't know. I mean, I don't know how much money, how much financial blood the state of North Dakota should spill to exit it. Maybe if we do it in an orderly way, save ourselves some money, still accomplish the same goal, but maybe on a longer timeline. Is that a fair description of what's going on right now?
Yeah, that is. And there's a distinction between there's a distinction between how the funds are managed by our fund managers. There's some of them are separately managed equities or separately managed bonds. Those ones are easier to exit the position because we can say, sell XYZ asset without jeopardizing the whole rest of the fund we have managed with that investment. But the vast majority of our investments that have exposure to Russia is essentially us buying mutual funds. It's investing in much larger funds, overarching funds with emerging market mandates to be focusing on this international piece, and we'll invest $250 million with a fund manager, and across there that's now invested at almost like a mutual fund where everything's pooled together. So that's called a consolidated fund. And so we can't directly sell exposure of $500,000 that we might have in a bond piece there. Rather, we have to sell and divest our entire $250 million position to get rid of $500,000. And so when we do that, that comes with, depending on what the contracts were with those fund managers, with any potential penalties, with any basis points, fees that have to be paid for that can all add up to where we might have some penalties that are more than the cost of our actual investment. And so that's where we've been putting pressure and exerting pressure, just like institutional fund all across the country have been, of putting pressure on our managers to try to get them to divest from the portfolio and divest some of the Russian exposure. Because if they do that on their own, instead of them custom making a fund for us and creating a little custom index for us, it saves us manager fees, it saves us costs, it saves a bunch of stuff, but it still accomplishes the goal of eliminating that Russian exposure. And so that's what we're working on doing, is getting those directives out there. And then our managers that aren't complying, the managers that aren't going through with divestment on their own, that's where we met yesterday, and we're empowering our staff of how to take corrective actions going forward.
Well, I think that's all perfectly reasonable. And I mean, it's we have a strategy in place. I think what really interests me now is our philosophy about these sorts of investment going to change going forward? Now, I know certainly that's the case with Russia specifically. I think they're probably going to be I was just reading before somebody wrote an article that they're going to be a pariah state probably for at least a generation. I suspect that's probably true. So that's probably not a hard choice to make at this point. To me, I'm wondering, does this, at least in your mind as one member of the board, does this change our philosophy when we start thinking about investments in Russia or a China or a Venezuela or some of these other nations?
And I think it has to. And this is conversations that I had, back in 2019 when I first was able to get a deep dive with former CIO Dave Hunter on the board when he was presenting to our appropriations committee. We started talking about how they go about with some of these assets, how they handle some of these investments. That China has always been a topic of conversation. Russia has always been a topic of conversation. Countries like Saudi Arabia have always been topics of conversation. So how do we go about getting some of that information and making sure that we're putting our money where we want it to go? And a lot of that comes down to what our investment staff have in terms of manpower and resources to be able to do that deep dive, do that digging in, and find out what they need to as they're making those investments. So that conversation has been ongoing. I know I spoke ad nauseum with Dave Hunter about this throughout 2020 and 2021 before he left our fund and is now down in Texas. And we've been having the conversations, with our new staff, and Scott Anderson, who joined us as a CIO here just about 5 weeks ago. He's had a real fun warm up right as he's been getting going on this fund. And so we've been working on how can we come up with a better approach. And so this conversation's been ongoing for years. We started having discussions about making sure that we set up our governance policy so that we have really good, clear guidelines, and we don't just get politically reactionary to things. That's stuff that we're always concerned about when we're trying to be prudent investors with over $20 billion of state money, is making sure that we have the system in place, so rather than reacting, we're able to take into consideration. So just at our last meeting, we finally approved the second and final reading of our new governance and policy review committee. So that committee is now going to be getting set up so that we can go through and work and put systems in place to make sure that we have the clear governance guidelines for our investment staff, so that we can continue to address these systematically going forward. And in the special session this fall, we were able to get additional investment staff on board or positions so that we can have those staff so that we can actually have the horsepower and the manpower to do those deep diving without having to rely on as much on outside consultants and outside fund managers to do this. That gives us a little more control, gives us a little more say, and also gives us more checking ability and tracking ability to put our money where we want it to go. So there are some states that have some great models in place, especially when it comes to the emerging market side. Tennessee is one that has a model that I really like. Their team does a deep dive on they do a screening of emerging markets every year, and every year they do the screening based off of overall constraints such as basically a corruption scale, and then also like looking at some of the government risk factors and other stuff. And if you're above 50% on the scale, they won't put any new investments into those countries or those securities. Below 50% is safe, and so that allows them to get some clear lines. And they didn't have any Russian exposure.
You said something that was really interesting about not wanting to be reactionary, and I think that's a really important point, because I've been probably I'm one of the ones who are out there saying, why are we invested in China? Why are we invested in Russia? And I think those are very easy questions, and those are very easy examples, right? Although we are still very invested in China, but I think we can look at, especially now in context of Ukraine, we could start to ask, okay, well, what happens if China takes a belligerent stance, invades Taiwan? And now we're in the same boat again, where maybe we're trying to divest from China. Maybe we shouldn't have been there in the first place. These are tough conversations that are happening. I mean, you look at the corn milling debate about the corn milling plant near Grand Forks, where, again, but for China's involvement, great project, absolutely should be built, great for North Dakota. And I completely understand people like Grand Forks Mayor Brandon Burchensky. I mean, these are smart people who are trying to do what's best for their community. But there's a larger question here that's a painful question to ask, is when we do business even with companies that are based in these regimes, what are we saying? I mean, that's a tough thing. But on the other, to your point about being reactionary, that becomes a harder question when maybe you talk about Saudi Arabia. Not a great human rights track record. Also, though, an important ally for the United States in the Middle East. Some of these are tough questions. I don't know. And also, speaking of reaction, look at what we've done with some of this, like California bans official state travel to North Dakota, right? So are we going to start doing that where, I don't know, the state of Washington does something that North Dakota doesn't like, so now we're going to ban investment in Microsoft because they're based in Washington? I mean, I don't want to go down that road. I don't want to be reactionary, but I think there's a way to bring morality to some of this, right? I mean, I think there is a line. I think it is possible to draw a line and say on this side of the line, investing is okay, and on this side, it's not.
And I agree, and that's kind of what some states like Tennessee, what they've been able to do in putting a screening methodology in place so that they're able to create that line, because that creates guidance, and that doesn't necessarily say that you immediately off-sell everything that you might have previously acquired, but you don't put any new money into there, and you will slowly start to eliminate those positions as they mature, as they come due. Because you're right, and the China example is going to be incredibly complicated, and that is one of the reasons why we want to have some of these systems in place, because in a globalized economy, everything touches China. Apple has manufacturing there. Disney, one of the most American companies you can think of, gets a huge chunk of their amusement park revenue coming out of the Hong Kong amusement park that they have in China. I mean, it's just everything is so intertwined, and that's one of the areas that hit us with some of the Russian exposure too. We have investments in companies like BP and Exxon. BP and Exxon each have partnerships in place with some of the Russian-owned oil and gas companies, and so we're investing in American companies or European companies in the case of BP, but then they expose us to those Russian investments as well. And so that's where it becomes really difficult for us to manage that. And that's why it's important that we give our investment team and our advisors the resources that they need to be able to do this and dig into the details on this. And it's also important why we set up the guidelines and the policies appropriately so that we have those benchmarks, we have those plans, so that we know we're making prudent investments going forward. Because your example of Washington is absolutely right. We've sued Washington because they tried to shut down North Dakota oil and coal from being able to be shipped there on trains. So we've been in active litigation against Washington. We've been in active litigation with the feds in D.C. Does that mean that we don't buy U.S. Treasury notes while there's a Democratic administration there because we're fighting them? We need to know kind of what is a good, smart, prudent strategy for dealing with these things instead of it just going with the whim of an administration. Because as much as we hate California and a lot of the stupid stuff
I love California.
There's a lot of
I love Californians. I love California. I'm glad they're part of the country. I'm not real happy about their political leadership at times.
Yeah, absolutely. They make a lot of interesting decisions to say. But for some reason, Silicon Valley is still where a lot of these companies want to go and start up and do tremendous business. And so we just need to make sure that we have an appropriate plan and strategy in place for how do we weigh risks, especially in an emerging market, but also for all of our other investments.
So how does that, I think that's so important what you just said about risks, because we've kind of, I think a lot of times when we talk about this, we very rightfully kind of talk about it in moral terms, right? Like the Chinese state has millions of people in concentration camps, right?
Absolutely.
Russia invaded Ukraine. I mean, these are very obvious things, but there's also a risk factor too. If the more belligerent China becomes, just as an example, and if they were to, the risk that they might do something in Taiwan and prompt another sell-off where people are fleeing from it, that's another risk to us, right?
Yeah.
That makes those investments, that needs to be part of the conversation too.
Absolutely. It creates a fire sale scenario. This is right now, one of the reasons why we are trying to do a strategic exit out of Russia is, we could offload the last few remaining securities that we have, less than 0.1% of our total fund. We can off-sell those at 20 cents on the dollar. But if we can get 80 cents on the dollar instead, that puts us in a better position. If we have everyone trying to run out of China at once, which I don't think is necessarily going to happen just because of the global economy, they're the second largest economy in the world, the fastest growing economy in the world. It's really, really difficult to find international investments that don't have Chinese exposure. It's really difficult. But we want to try to mitigate that as best as we can and try to limit that risk, especially into these state-owned companies and the state-owned entities that cause us national security concerns.
Right, like when and I want to ask you that question, like as a member of the board, in your mind, what's the right strategy? Because to me, I'm listening to this, I don't want to not invest in Ford because they sell cars in China and have and obviously have all the the apparatus and the business file in factories and dealerships and everything that go with that. They're an American company, and okay, they're serving a market in a place with a not so great government. That to me is different than I'm going to invest in a Chinese company that is used by the Chinese Communist state to implement censorship, right? These are distinct things. Like, I'm not so worried about the Exxon, an American company, has invested in energy development in Russia.
Sure.
I'm interested in, let's not invest in Russia's state, Gazprom, Russia's state-owned gas company, right?
And that's the sort of direction that we're working to try to give our fund managers. That's where we need to be more diligent and set up the policies in place so that we can utilize our proxy votes really well, especially with some of the larger funds. Like an entity like BlackRock that manages $9 trillion of institutional funds all around the world. We have some investments in BlackRock into some of their funds. We need to make sure that we're leveraging our horsepower, leveraging our votes effectively to try to make sure, especially with the commingled funds, that they're not putting us into those bad positions. Because that's how we got into some of these things like Gazprom and everything else. We want to make sure that we're diligent on that. That's where we want to make sure that we have our team equipped and have the capacity to be able to take care of that. There was actually a really good presentation that we had at our January board meeting. One of our fund managers that did have about $600,000 of exposure into Russia, but they've been working on winding it down. Axiom had gave us a presentation in terms of how they manage that risk, and they used the example showing us like Alibaba. Like, if you just looked at pure market returns on Alibaba, they, as a fund manager, would say this looks like a great investment. But when they started adding in some of their other risk factors, the governance risk factors, the social risk factors, et cetera,
what happened to Jack Ma, their founder?
Then that moved them out of an investment piece. So then they said this is an example of how we weigh these risks from a risk reward scenario and then don't put money in there. And so they gave a really good presentation to our board on this in terms of how they work to manage these emerging market risk scenarios. And that's the sort of diligence we need to make sure that we're following and that we're institutionalizing here to address this stuff going forward. Because it really is just about making sure that the strategy, and that what are the benchmarks that you have to hit, or the things we have to specifically avoid, so that we can avoid politicizing the fund. Because we want to make sure that we're still getting a good, prudent return. And state law says we have to be going after market returns. We actually also have to navigate around Senate Bill 2291 passed that says that it bans social investing, which on the flip side means you can't socially divest unless you're able to still generate that market return.
Which is that gets into the complexity we were just talking about. I mean, on one hand, North Dakotans don't like what do they call the social investing, where we're not going to invest in oil companies.
It's the ESG
anymore.
conversation. Yeah, it's the don't divest fossil fuels for green energy. That's a terrible strategy overall.
Right.
Is North Dakota, our fossil fuels.
That's the sort of political silliness we want to avoid, right? I mean,
absolutely.
We want to say we're not going to do business with people who put other people in concentration camps. Right. But we're also not gonna get stupid and say this state has a Democratic governor, so we're not going to invest in that state.
And if we put all of our money in the mattress instead of actually making investments like this, then at a time like right now where we have insane inflation, we're losing money.
Right.
So we have to make sure that we're managing those risk reward appropriately, so we're still getting good sound returns for our citizens.
I want to zoom out to like a 30,000 foot view for our last couple of questions here. I have sensed, and this goes all the way back to the 2018 Senate race, where soybeans suddenly became a huge issue, and we had a presidential administration that was trying to play some hardball with China. We can have a debate about whether or not that ultimately was a smart move, but I mean, it suddenly became a question, and it was almost like, at the time, I started talking about how our thinking, our foreign policy, our economic policy towards China can't just be about soybeans or anything else. We have to start. Do you think, because I think for a long time, you look back, going back to like even I think as far back as Reagan, but really during like the Clinton administration when China got most favored status, there has been a long-standing belief that it's not entirely unfounded, that if we traded with some of these not so great places, that we would knock the rough edges off. We would expose them to the wonders of market-based economies and all the prosperity and opportunity that those can generate. And over time, we would almost like infect them with a market-based economy. And
it's the old McDonald's strategy.
Right.
The thought process was always two countries with McDonald's never go to war with each other. But I think
in a lot of places, I think it worked. I think you look at Japan. You look at post World War II Japan. It worked, right? It has not worked in
Germany.
It has not. Yeah, worked in Germany. Has not worked in China. In fact, they have turned it around. Do you think that? I mean, to me, that's a shift in thinking over the last few years. Do you perceive the same thing?
Yeah, I mean, I certainly think there's a lot of that, and there's, you always get the rise and falls of nationalism versus working together on a global scale, because you have global issues, global problems that need to be addressed, but you also need to protect your own citizens and your own national integrity, and so it's a balancing act between all of those, and that spectrum almost seems to ebb and flow, and ever since Nixon opened up trade with Asia. We were really trying to, bring in the East and, help incorporate them into Western culture, help bring capitalism into some of these areas, like South Korea, which has done phenomenally well since we started introducing capitalistic markets there, and really helped change that. And so our hope has always been that, sharing the U.S. dollar, sharing, goods and services, and getting those trades and that international reliance would have overall positive effects on some of these countries, but then you end up running into a regime that has such autocratic control over its state that they get some of the benefits of capitalism, but they don't actually embrace it, and that becomes problematic. Yeah. And I think, and you have that warring faction within China right now. I mean, you look at the areas around Hong Kong. British control for so many years, they really grew a great capitalistic culture there, and then you see the internal strife now that it's back into China, and the people still wanting that capitalism, still wanting that international market exposure.
Capitalism in service of the people, not capitalism in service
Correct.
of the state.
Right. And so you see the people in Hong Kong and in that area really, wanting this and wanting to be a part of this and wanting to have, all of the good things about the Western culture that come into it. But then you have the state here trying to stamp it down and them doing their own stuff. And they've got billions of people. So they have so much more resources from a consumer standpoint to exercise power over the world, from whether it's their manufacturing
it's a lot
side or
easier
else.
when you're a dictatorship and you could just make people do the things you want to do.
And when you could pay them for 10 cents a dollar, if even that.
I was
a level of control.
One of my favorite metaphors for talking about democracy and like America, it's like we're playing a video game on a harder difficulty setting than other places, right? When you're Vladimir Putin and you could just shut up the people who are saying things you don't like, or you're China and you could just put them in a camp somewhere, the people who disagree with you. That's not good. It's horrible. It's all the things we've been talking about, but gosh, it sure makes governing easy here.
Oh, yeah. I mean, because we have to worry about protecting the institution, protecting our system as a whole.
Protecting property rights, protecting environmental rights. I mean, everything else that we do, it's hard. Well, Thomas, you promised me a half hour, and we're almost exactly a half hour, so I certainly appreciate your time. Looking forward to watching this. It sure seems like we have a good plan in place. And I look forward to this debate about how we're going to tackle, because this is newly important, or not newly, but I mean, it's
been important for a long time, but it's certainly at the forefront of people's mind. And I know we're working on scheduling a land board meeting for next week to go through the investment side over there. Similarly, we've been working through our fund managers and everything there, but we have a much smaller investment team at the land trust department. So it's just taking a little more time to do that. We're taking care of this. We're making sure that we're doing, what we need to do to prudently invest on behalf of the citizens. And then on the next topic that we need to get on and talk about, then we have to continue to shift our focus and our resources and really ramping up our in-state investment piece and putting our money back to work for our citizens there as well.
Well, that's the thing too, is there are so many opportunities right here at home in America, and specifically in North Dakota. I mean,
we need to find more Dots Pretzels, find more Aldeveron, some of these home run companies that help our citizens.
Some of the stuff with Governor Burgum's, I mean, even just in the energy field, we're like $30 billion in investment. The carbon capture stuff that's coming to the state, which I think
my entire life, I can't think of a time where we had this much economic opportunity in our state as we have right now, with all these new projects working to come online.
Carbon capture looks to be a whole new industry unto itself.
It's going to revolutionize everything. I mean, we know that the constraints on natural gas is limiting our oil and gas companies here in North Dakota and what we do with that gas. We know that the offsetting carbon is something that's being pushed up at the international level and nationally, and companies are paying a lot of consideration to that. If we can get this going here in North Dakota and be the ground zero of that capital investment, I mean, it's going to be night and day from what our economic outlook looked like 20 years ago to what it'll be 10, 15 years from now.
Amazing stuff, but a topic probably for a whole other episode, because we could probably spend hours just talking about that. Thomas, thank you for your time.
Thank you, Rob. Appreciate it.
Want more political news like this? Visit inforum.news/port to get 3 months of unlimited access to our news network for only 99 cents a month. Don't wait. Get this limited time offer at inforum.news/port now.